Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. I have with us over the next couple shows a guest, Ian George, and he's a brokerage director with MassMutual. Welcome, Ian. Thank you for coming to join us.
My pleasure. Thanks for having me.
The reason I have Ian with us is I get so many questions, especially from business owners, but individuals and retirees alike, on different forms of life insurance, and Ian is an expert in life insurance. So I wanted to bring Ian on the show to go through a number of different choices, alternatives that we have, evaluations that I want many of you listeners and viewers of the show to know whether your policies are healthy, how to do checks, what to look for, what different forms of life insurance are available for those of you who are looking to purchase life insurance. And also, Ian's going to help share many ideas on how to determine if we even need life insurance, what the benefits are, and things like that. So, Ian, again, I'll turn it over to you to pick up where you think people ought to begin with a basic explanation for starters.
Okay. Well, basically, over the years, what I've discovered is that people from all walks of life have essentially the same kind of questions, which is they're not quite sure what types of life insurance exist out in the marketplace. And more importantly, obviously, after they figure out what those are, what type is right for them. So I do find it's best to give people some foundation in terms of what the basic types of life insurance are. As an industry, the life insurance companies have done a great job of giving different life insurance products all sorts of different names to make things extra confusing. So I'm here to tell you that the good news is that there are basically only 3 types of life insurance. And what I will do is go over and explain how those work one by one, and give people an idea so that they can see how those work. So the basic 3 types of life insurance are term life, universal life insurance, and whole life insurance. Now, obviously, the easiest to understand for a lot of people is term life insurance, and it's considered to be pure insurance. You basically pay your premiums, covered for death benefit, there's no cash value, nothing else that goes on with it. The reason it's often called pure insurance is because basically what you're doing is taking the amount of insurance that you want, and it's calculated on the components of what all life insurance contracts contain. And that is, first and foremost, is a death benefit. Whatever somebody wants to have to be, their life insurance amount, their death benefit, that's going to be a part of all forms of life insurance. The next thing you're going to have is what a lot of people don't know about, and it's called the mortality charge. And all a mortality charge is basically what the insurance company needs to charge. In other words, when they figure out what the risk is that somebody would die. So as an example, you have somebody who's in their 20s, their mortality charge for the amount of life insurance they would buy would be lower than that of somebody, say, in their 60s, because the odds of somebody dying in their 20s is much lower than the odds of somebody dying in their 60s, so that means that their charges would be lower for that. Mortality charges in term life insurance correlate pretty close to what's going to be charged to them in premium. So the insurance company is going to pad in some added features on top of their mortality charge, obviously, because the insurance companies need to make some money when they're selling and protecting the public with their insurance policies. So it's going to be mortality plus some income from the insurance companies, and then you're going to have the premium that you're going to pay. Traditionally, those premiums have now gone on to be level. So as mortality charges grow, and they grow year over year, most companies now offer programs that levelize your premium so that you're paying the same premium for, say, 5 years, 10 years, 20 years, or 30 years. And that's term life insurance. So if you look at it, you have a very level death benefit, so whatever I want to pay in death benefit, And then I'm going to have my mortality charges, which are going to go up over time. So the older I get, the more I'm going to pay for my life insurance. With level premium, all they've done is factored that in and flattened it out, again, for what we talked about, that 10 years, 15 years, 20 years, 30 years. So that's term life insurance, plain and simple. The next product that comes into play is universal life insurance. And universal life insurance might be one of the most confusing programs and products that the insurance industry has ever come up with. It has gone through a number of different changes. But let's go back to the basics. Universal life insurance starts with the same place that all life insurance starts with, that our term started with. So we have the death benefit. And the death benefit is the number that somebody's going to pick. Now, we know insurance companies have to charge for that death benefit, so just like your term life insurance, there's going to be a mortality charge. The cost that that insurance company deems it's going to take to cover the death benefit you're going to do. Now comes the added feature, or now the confusion comes in, because now we're talking about cash value. And cash value that sits inside a universal life insurance contract is designed to grow over time. So what happens is, you pick your premium. So to a certain degree, on universal life insurance, your producer, agent, or advisor is going to help you determine the amount of premium that you're going to put in. Now, you're probably not going to put in the minimum premium amount, because that would be term life insurance, because they're going to give you the bottom and base amount for your mortality charge, and you can pay that. Now, if you pay that, it's going to demand that you pay more and more each year, because that mortality charge is going to be going up each year. But generally speaking, they're going to pick some money, so pick a premium amount rather, that you're going to put in there, and whatever is remaining from your premium after the mortality charge is taken out is going into your cash value. The problem with universal life insurance is what we've already referenced. What's going on inside that contract year over year over year? There's a charge in there that is constantly going up. Now, over time, as you can imagine, somebody in their 20s may not notice that charge as they're pushing money into one of these life insurance policies, but over time, their mortality charge as they go out of their 20s into their 30s into their 40s becomes more and more expensive. The other aspect of it too is this can sometimes be hard to see within your policy or your charges, because you are actually only being charged on the difference between how much cash is built up and how much your death benefit is. As an example, if I started a policy that was $100,000 in death benefit, year one, I'm paying my mortality charges, my fees on all $100,000, because I don't have any cash value. Down the road, if I've accumulated cash value, and let's say there's $50,000 in cash value and my death benefit remains at $100,000, I am now only buying $50,000 of life insurance, because the other $50,000 is my cash value. So that upon my death, I just get my death benefit. So where that gets confusing is people can look at their charges and see that they're not buying as much life insurance, but actually their cost is going up. The trouble comes in with these policies when I go to either use my cash value or if I reach a point in time where my mortality charge has increased greater than my premiums, which means the policy only has one place to go to make up the difference so I don't pay more premiums, and that's in my cash value. So as you can tell, there are a lot of working parts in universal life insurance that can make it hard to work with and a little difficult to understand for a lot of folks. Not to mention the fact that we've come out in the industry with so many different types of universal life insurance that it doesn't make it any easier. So when universal life, again, first started, it was based on interest rates, and this was back when interest rates were very high. So the insurance companies were offering a product where people could take advantage of the very high interest rates. It was a horrible time to buy a house, but it was a great time to put money into CDs. I don't know if anybody could even remember the days when you could put money in a CD and get 10%, but they existed, and that was also going on inside these policies. Obviously, those days came and went, and when the interest rates dropped, so did what these policies were doing. When that occurred, these policies with the interest sensitive portion became less popular. Then came along the most recent incarnation of what they're doing with these universal life policies, which is called indexed universal life insurance policy. Now, if you thought they were confusing before, the indexing of these policies is only added to make them that much more confusing, because now not only does the client have to understand the variables that change inside a universal life policy on its own, now they have to understand how their interest is going to be calculated. So at least with the traditional interest-based universal life insurance policy, it was like having a savings account. They told you what your interest rate was, and that's what your interest rate was, and off it went. The indexing is supposed to can be tied to a market index, such as the S&P 500 and things like that, but you really have to be very careful with these policies, because you don't really know exactly how your interest is going to be credited from year to year, because it changes. And that's where universal life policies have basically come to today. All three are still available out in the marketplace. A traditional universal life with interest, a variable where money is finding its way into the market, and an indexed product where the markets are just being used to calculate the interest. There is one form of universal life insurance which is easy to understand that does work for some people, and that's called guaranteed universal life insurance. Jack, you and I have talked about guaranteed universal life insurance in the past. We basically talk about it. It's term till you die.
Right.
And that's basically what it is. Guaranteed universal life insurance is essentially a premium that is guaranteed for the rest of your life, with a death benefit guaranteed for the rest of your life. And that can be all the way up to age 121. As we have gone over, in some cases, you can pay your premiums for a short period of time for guaranteed universal life insurance and keep your death benefit in force for the rest of your life. Just know that there will not be any cash value associated with these policies. It's all going towards death benefit. Some policies will show some cash value at a certain time, but you have to understand with guaranteed universal life insurance that if you touch that cash value, the guarantee is removed. So while you can see the cash value, you can't touch it.
And that's important.
It's very important. Also, it's important for clients to understand, if they're working in that area, that if they happen to forget a premium payment, and that then would have the policy look towards its cash value, they then lose their guarantees as well. So they're very fragile contracts, but they will keep all of their promises, and they are easy to understand as long as you're very diligent what you pay. Now that brings us to whole life insurance. And whole life insurance is actually a fairly easy product to understand. We had talked about our basic components of life insurance, and so let's go back and revisit those. Our first basic component of life insurance is death benefit. Now with whole life insurance, obviously that carries a death benefit as well. So you're going to pick your death benefit. The next thing that happens is we need to know about the mortality charge that goes on inside that policy. Here's where whole life insurance is different than term life insurance or universal life insurance. That the mortality charges on whole life insurance are fixed and guaranteed level for the rest of time. This is nice because it makes it easier for people to figure out what's going on inside their contracts. So whereas universal life insurance is constantly going up, and then there's a calculation of how that charge is taken out of what you're paying into your premiums to get your cash value, and then you have to figure out how that's calculated. Whole life insurance kind of does away with that and basically says, no, here's your mortality charge and here's what it's going to be, and off it goes. Your premium also with whole life insurance is there's going to be a base premium that makes sure all the guarantees can come true. The underlying guarantees on any whole life insurance contract are basically this: that the premiums that you pay in will go to your cash value and to cover your death benefit, and at a given year your cash value is guaranteed to be worth as much as your death benefit. For most policies today, that's at age 100. So it doesn't mean that that all that has to happen by age 1. Well, actually, the policy guarantees that all that will happen by age 100, but it doesn't mean you have to live to age 100 to keep it. The other aspect is that you throw into what's happening to that cash value. So you have that underlying guarantee, but you can get more. So those are either if you own a policy through a mutual company, which are companies like my company is Mass Mutual. You have Northwestern Mutual. You have New York Life. You have the Guardian. These are your bigger mutual companies. We have Ohio National. We have National Life of Vermont. You have Penn Mutual. So you have small mutual companies that are out there as well. The mutual companies, and this is where it's important to understand this if you're looking at a whole life insurance contract, mutual companies are owned by their policyholders. So a policyholder of a whole life insurance contract with a mutual company is being paid dividends. That's how it's done. So if somebody has a policy with any mutual company, there are no stockholders other than the policyholders. You can't find them on the New York Stock Exchange. They're not out there. Other carriers do offer whole life insurance. They just won't be paying you dividends on their whole life insurance contracts, as their dividends are paid to their stockholders. Policyholders are going to get interest rates. So that's how those contracts basically work. With the dividends or interest rates on a whole life insurance contract, those are paid above and beyond the guarantees. They're going to do a couple of things. In most contracts, they're going to grow your cash value above your guarantee, and in other circumstances, they're going to pay or grow your death benefit above your initial. So it's not uncommon to watch on any whole life insurance contract to watch all of your cash value grow and your death benefit grow. And that's why whole life insurance has been seen as a more stable program for a lot of people.
And it's important to point out that dividends with the mutual companies are not guaranteed.
No, they're not. Dividends are not guaranteed, and they do, however, the cash value does have an underlying actual guaranteed amount.
Right.
But no, the dividends themselves are not guaranteed, and they will fluctuate. So that is important to understand with anything. So your policy will go on over time. The other thing that whole life insurance contracts have are limited pay contracts, and those are offered by a number of different carriers, offering you the chance to have a policy paid up in 10 years, 20 years. Some policies can be paid up at a certain year of, the insured, say at age 65, they want to make sure it's all done. That can be done as well. And that's basically Insurance 101 with our term life insurance, our universal life insurance, and our whole life insurance. Now, I know a lot of people do get confused, Jack, when they talk about all these programs, and somebody says, yeah, but what about single premium? Well, the funny thing is that single premium life insurance can be paid into any one of those three contracts. So single premium in and of itself isn't its own type of life insurance. It's actually a choice within any of the three types of life insurance. So how those companies choose to offer different options within those contracts can also get confusing. But what you want to know when you first start hearing about life insurance is what is the basic type of life insurance. And you can ask your producer or agent or anybody you're talking to, is it term, is it universal life insurance, or is it whole life insurance? And then you'll at least know what you're starting with as a foundation and the blueprint for how that product works.
And is it true that in any of the forms of life insurance, whether it's term or universal life or whole life, the death benefit, if payable to a designated beneficiary, an individual, is income tax free no matter which form of insurance that you have?
That is true, and except for one particular area. Well, it would be income tax free, but depending upon individuals, it may cause an estate tax, which is why you need to work carefully with your advisor to understand how your policy is being owned. So nowadays, if you're an individual and you're buying a life insurance policy and your life insurance death benefit proceeds take your overall estate over $5 million, you could be subject to some inheritance tax as well as estate tax. That's when you might want to take a look at having your policy inside of a trust in terms of how that goes. But yes, you can easily, with some very simple diligence, make sure that the death benefits of your life insurance policy remain untouched by taxation.
And then the other area with life insurance can sometimes be probate, where you get to name designated beneficiaries on the life insurance.
Yes, probate is avoided, as you know, and some of you may know, is that probate is avoided on any beneficiary designation. So that is not only life insurance, but it's annuities, it's your IRAs, it's your 401k at work, or your any plan that you have at work where you're forced to, give a beneficiary. And what probate does is that's avoided as soon as the court's not involved. So anything that's already been pre-deemed, and that's where life insurance is obviously a front runner, because while people may forget to put, beneficiaries on some other items, they'll never forget to put beneficiaries on their life insurance policies.
Because the one point I'd want to make to everyone is when you talk about life insurance, the beneficiary designations override any designations you might have in your will. Because Ian just said it bypasses probate. If you have beneficiary changes that you've made in your will, who you want your heirs to be, let's say you had a divorce or a falling out or new children or whatever, and you update your will and don't update your beneficiary designations, the issue will be the will is not seen through life insurance. The beneficiaries that you have listed, even if they're old and defunct now, will be the only designations the life insurance company sees when they're paying out the benefits. So make sure to update both your wills and your beneficiaries when we talk about life insurance. All right, well, that's it for today's show. I appreciate everyone tuning in. I'm going to have Ian back on a couple of the next shows. We're doing this as a series, and we'll air them each week. So, Ian, thank you very much for coming in, and until the next show, I appreciate it.
My pleasure. Thanks for having me.
Thanks.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.